Sticky inflation and a strong job market has sent jitters through markets over the past few months as investors brace for the possibility that rates could be higher for longer. But one investment vehicle has been seeing some benefits from the high rate environment: municipal bonds. Joining us now is Dan Close, Nuveen's head of Municipals. Dan, thank you so much for joining us. Now, there is this expectation that the Fed could begin to cut rates later on this year. Right. Given that, is now the appropriate time to put some money to work in munis?
Sure, and thank you so much for having me, Ali. I do appreciate it. We certainly think so. I mean, if you look at what's happened to munis so far this year, there's been two broad themes. One is Treasury rates on 10-year Treasuries has gone up 50 basis points. So that's affected everything in fixed income, including munis, and 50 basis points cheaper than we started the year. And the second thing that's really impacted munis and why we think it's such great value right now is the supply of munis. We've seen supply go up of municipals through the end of May, up 40%. And with that, we've had two back-to-back months, the months of April and May, where we saw more than 40 billion of supply. I think what that really does is it sets us up really well for the second half of the year. The second half of the year, I don't think we're going to see as much issuance. We're hearing from underwriters, we're hearing from issuers, bankers, that they're bringing deals forward that normally would happen in the fourth quarter so that they avoid the election and they avoid all the issues that happened in the 2016 election. So I think we'll have less issuance, and I think we're also going to have a very, very good technical the next 2 months, where you're going to have $80 billion in coupons, in maturing bonds, in all these different proceeds that recycle back to the muni market very quickly. And those are both very, very good technical backstops. And I think as well, as we were discussing right before, 6.25% for a AA intermediate muni strategy, I think is very attractive. And 9.25% for a high yield, I think is just a number which is going to go in and draw investors off the sideline.
Yeah, I mean, those are significant yields, particularly when we're used to talking about things like treasuries, corporate bonds. The returns are just not as high. I am curious in terms of risks for those returns. How closely are you and municipal bondholders supposed to be watching the macro data and any potential softness we might be seeing in that data, and what read-through could that have to munis?
Yeah, sure. And we have 23 credit analysts at Nuveen where all they're doing is looking at the broader macro. And I think as I take a step back and look at it, we don't usually see a high correlation between the economy and defaults in municipals. Mm-hmm. By that I mean, your water and sewer bill. You're not going to go in and fail to pay your water and sewer bill no matter the economy. It's a really inelastic demand curve for most of what these have. These are essential service monopolies.
Somewhat recession-proof, is that fair?
Somewhat recession-proof. And almost everything we see, we just don't see a large correlation between defaults in munis and where the where the economy is, yes.
And given that, the muni space very fragmented, what sectors or areas are you most bullish on right now?
Yeah, so more than 50,000 different issuers. In the town I live in, I'm just north of Chicago, there's 9 issuers alone in that town. So it is a very fragmented market. On the high grade side, we're really looking at local general obligation bonds. These are bonds that are repaid by property taxes. We think with the housing market continuing to do well, that's a very good place to be, and they're offering very good yields. On the high yield side, we're really favoring land secured deals. These are deals that are financed by build outs in states like Florida for potable water, for streetscapes, and that are ultimately repaid by property taxes and different assessments. So we're very bullish on those two. We think those are going to do very well, recession or no, here over the next couple of years.
I do want to bring this a little bit closer to home here in New York City, because Governor Kathy Hochul did move to kill congestion pricing policy, and now some are calling on MTA muni bond holders to fight back against that move. I want to pull up a post from the director of a nonprofit focusing on public enterprise saying that I'm calling on anyone who purchased MTA muni bonds to come forward and bring the law to bear on the state of New York. I'm not going to ask you about congestion pricing. We're not going to get into that tit for tat here, but I am just curious generally, how much power historically do muni bond holders have over public policy? And is this a way for investors, retail investors listening to this segment now, who are invested in local politics, to maybe have another avenue of influence is not the word I'm looking for, but influence.
Yeah. Well, and it's interesting to see that congestion pricing would have been, we think, very favorable for muni bonds. You go in and you take $1 billion in what we expected the revenue to be. You could leverage it up to $15 billion by issuing debt that really helps out the capital structure. You know, if you go in and you have fewer cars on the street because of the congestion pricing, then you also go in and support the Fairfax bonds. You know, owning muni bonds, you don't have, unlike on the equity side, where you could go in and you could vote for directors and you could vote for different governance issues. We really don't have that as much. As large holders in the MTA, we certainly do have influence, but it's something traditionally asset managers, at least on the municipal bond side, have really exercised to too much. We have a 125-year history at Nuveen of providing tax-exempt income. Part of that is also knowing that sometimes the local matters and local affairs not weighing in on as much.
Well, really quickly here, I know that you had a take for us on airports and muni
Yes.
bonds, and obviously huge travel demand coming up this summer. What read-through does that have to airport bonds?
So airport bonds have done very well this year. We've seen about $3.5 billion of issuance. So Midway, SFO had an issuance. We've seen issuance come through and anticipate about $20 billion or so of issuance for the balance of the year. So I think it's been interesting. Airport credit has done really well. You think of airports that lost 80% of their top line revenue, and yet we have more upgrades than downgrades, and 25% of them are better rated than where they were before the pandemic. So in airports, we expect more issuance, and a lot of this issuance is not being driven by runways, it's not being driven by gates, it's being driven by the passenger experience, lounges and restaurants and shopping. And so it's more of an experience rather than that we're financing rather than the traditional brick and mortar. So we do anticipate more airport issuance for the balance of the year, fully $20 billion for 2024 and $150 billion by the end of 27.
Really interesting, Dan. It's always great to speak with you because you have an ability to bring muni bonds into the reality for folks. So really appreciate it. Thank you for coming in studio.
Thank you so much for having me.
That is Dan Close. He is Nuveen's head of municipals.